July the 16th, 2021. It's 8 a.m. on the west coast of the United States. Life is hard for the creative class, for creators like Keith and I. But Keith, the news this week on the creative class front is good. More money coming in. We may not need to get up at 8 a.m. now for future Fridays. Is that true? We're going to be paid to do nothing.
Well, it could be good. Here's the story. Cash for creators. It's happening, and those are $100 bills and $50 bills there because Facebook this week announced it's putting $1 billion in a pot to pay creators to use the Facebook platform tool.
Is there a pot big enough for $1 billion of Facebook money? It would need to be a big pot, Keith, wouldn't it?
Well, or a digital pot, Andrew. It could be a very small digital pot.
But even a digital pot would need to be pretty big to fit $1 billion.
Yeah. Anyway, yes. So is it good news? Is that, the interesting thing is it good news? Like, would we take some of that money for our show and move our show off of Restream and Review and put it on to Facebook? Would we do that?
Of course, we'd say no, but we would if our friend Mark Zuckerberg with his toilet bowl haircut came to us and said, "We'll give you a few million to put your show on Facebook." Even I would find it hard to say no. Would you?
I actually would say no, mainly because my goal with the show isn't really related to money. So it wouldn't matter to me. I mean, it costs. Let's tell the dirty truth to our listeners. It actually costs us under $300 a year to run this show.
Yeah, but that's in hard cost. The opportunity, the opportunity cost. I mean, we're not wasting our time. We wouldn't just do it for the sake of it.
Well, that in a way, that's what I put in the editorial. Why do creators, which is like this loose word that describes a wide range of different people, why do creators do what they do? And the point I made, actually, my wife disagreed with me on this initially. We had a discussion about it. The point I made is most creators don't do it to get paid directly for the stuff they create. They create stuff to enhance the real world presence where they do get paid. Like for example, you do speaking.
Yeah, I did speak. I used to do speaking, and it's coming back.
Or you write. You've written books. And presumably you make more money from books and from speaking than you would ever make from Keen On. Although Keen On also does give you some income.
Actually, Keen On probably pays better than books. Is the worst thing, but books generate speeches. Speeches are the creme de la creme of the creative industry revenue stream, and they're hard to get, but they're very well paid when you get them, and they're very well paid to essentially do nothing, to basically do what you and I are doing now, except people are paying us thousands of dollars per minute.
Right. So then what would we, even though you're not on Facebook, and I know you hate it, I am on Facebook, but let's just assume for a minute there was a use case for Facebook. It wouldn't be to dump these tools and use similar tools on Facebook, but Facebook does have a strong, compelling use case.
Yeah, I wouldn't have a problem. I mean, nobody likes Facebook, but my Keen On is through LitHub is streamed live on Facebook. I mean, everyone I know is on Facebook, so I don't see being on Facebook as being on quote unquote Facebook. It's just that the platform's kind of creepy. I'm curious, Keith. Why? What? It just seems to be such a Me Too thing for Facebook. Why are they wasting their time with it?
Well, they do have a history of doing Me Too. In most of the exposés that have come out about the way Zuckerberg thinks, he seems to focus in on anything that catches fire or takes off, and feels an obligation to copy those features inside Facebook, which tells you that in his world, his job is to suck in audience and use cases so that they can't exist outside of Facebook, or there's no compelling reason.
Why don't they just buy Substack? How much is Substack worth now?
Well, we'll come on to this in a minute, but in the world of venture that we're in now, it's worth over $1 billion, which is not because it's got revenues, but because Andreessen Horowitz put money
But
into
wouldn't
it.
that be a smarter use of Facebook's money, the billion for Substack, than just throwing a billion at creators and coming out with nothing because they can't compete with the real players in this space?
I think they only do that when it's game over. Like with WhatsApp, it was game over. WhatsApp won, so they were prepared to pay 19 billion to own it. They'd
Yeah.
rather pay more when it's game over than less when
Well,
it's still on
WhatsApp was a strategic. I mean, that was a different acquisition. So, who are the biggest players, do you think, in the in this new creative space? Is it Patreon? We've talked about them. Is it Substack? Who do you think are the most interesting, innovative new players here?
Well, I think if you break it down into the first generation and then I think we're right at the beginning of the second generation now. In the first generation, yes, Patreon played a big role.
I mentioned this. For many years ago, I interviewed Jack Conte pre-Patreon days when he was still a musician at the San Francisco Jazz Festival.
Right. Now, I think WordPress is part of the first generation. People
Yeah.
doing blogs. Wix is probably part of the first generation, and Squarespace. I think that first generation used Twitter a lot more than Facebook.
Yeah.
And I think at the end of the first generation, Facebook and LinkedIn have come to the party. Like we're live on LinkedIn right now because they have live streaming as well. Which
and I'm live on LinkedIn, and I'm actually really surprised with the fact that I have, I think, 5,000 followers on LinkedIn and 25,000 on Twitter, and my impact of my streaming on LinkedIn is way higher than on Twitter. So LinkedIn, I think, is an interesting platform, but I don't see LinkedIn as a competitor to Patreon. I mean, Patreon offers revenue services, or and the same with Substack. Does LinkedIn? Maybe I'm missing something.
No, I'd say if you break it into tools and distribution, LinkedIn is mostly distribution. Facebook should be mostly distribution.
Yeah.
And then there's the tools people, which Restream is one. I think the second generation, to keep that theme going, the second generation starts with Substack, Review, Restream, StreamYard, Hopin is coming to play.
Hopins for events.
For events, but it's, as creators, we probably want to do things with a larger audience on occasion.
And Clubhouse, of course.
And Clubhouse is part of the second generation. And these tools are largely free. Some of them you pay a bit for, but they're largely free. And what they do is they elevate interesting people into a bigger audience. And I think Twitter is being the most creative thinker about how it could contribute to that. It's actually doing a lot of things.
I'm not convinced with Twitter, though, because I think you need the culture, and Twitter's already middle-aged, and I've become so sick of Twitter because every time I go on it, there are the same people saying the same things. And I think what Twitter needs to figure out is how to give its users almost a spring clean, to stop them repeating themselves and being so incredibly boring.
Well, obviously everything's on Twitter, so you're unfortunate in that you're having that experience. I don't exactly have that same experience, but I think you're right. The problem is discovery and filtering, and I think
surprise and I don't know what the opposite of surprise, familiarity. Twitter has become so annoyingly familiar. And what's interesting, Keith, about your editorial this week is you've always been a big fan of this new economy, and yet you're also saying that it's you don't really think it's for real. That there is no such thing as a creator economy. There are creators and there are economics, but they don't necessarily go together.
Yeah, at least I don't think there's a new thing. I think there are people like Kara Swisher, who's excellent.
People like. There's only one Kara. She's a force of nature, I think.
Yeah,
and what she does, I'm not Kara, but I'm in the sort of rung or a couple of rungs below. And what I do is hard, but what she does is in my mind, impossible. I don't actually know how she does it.
She just works very hard.
She must replicate herself. Maybe there are a lot of virtual Karas, maybe some real Kara and some not so real
What I've
fake
noticed, by
Karas.
the way, it's worth saying this, is that CNBC is really good at mining the creatorverse. And so, for example, they pull in Kara, they pull in
Galloway,
Calcanis, Galloway, a bunch of others, actually. The Verge, one of the Verge senior editors. So there's beginning to be a kind of a new bunch of people who are very influential, but it's not a new creator economy. The people that used to make money still do with new tools.
right. And it's a winner. I mean, the reality is, this is my old argument, but I think it's more true today than ever. It's a winner-take-all economy. So Scott Galloway, Kara Swisher, Calacanis, so he's a slightly different category because he's an investor. They suck up all the money and energy, partly because they're way more talented than everyone else and they have more to say, and partly because that's the nature of this economy. And even the platforms are designed for superstars. They're not designed for a creative middle class.
Exactly. Well, what would happen is if there really was a creative economy, the long tail would irritate you, because
irritate me or all of us?
All of us, because it would be relatively uninteresting people. Maybe by the way, maybe we're two of them who you end up having to listen to. And so the quality gets drowned in the sea of creators. That could happen. And I think the solution to that not happening is really, it's something Steve Gilmore talks about a lot over many years, which is how attention and alerts and notifications need to come together so that the stuff you end up choosing to listen to is the stuff you want to listen to.
Yeah, I just can't remember. I just signed up for they're one of my advertisers on Keen On. It's an Australian app for news. Can't remember what it's called, but they're back to that old game of just aggregating different news and giving you news headlines. The one thing I think you have to be creative. If you're going to be a creator, you've got to be a good writer and you've got to know your grammar. And Keith, without wishing to embarrass you too much, in your editorial this week, you have one particularly bad sentence, which I'm going to read out to shame you. You're writing about how the creative economy doesn't really exist. And then you write, without giving away any confidence, TechCrunch revenue was very far away from the meme of $100 million by the fifth year of revenue. What does a meme of $100 million mean?
It's a bit of an inside baseball comment, Andrew. So you're right to poke me on it. In the venture industry, when startups are learning how to pitch, they all get told you need to be able to show how you get to revenue of $100 million within 5 years. So I've probably said it to you about Now TV. Okay, well, if you're going to get funded for Now TV, you need to get to $100 million within 5 years. And it doesn't mean 5 years, really. It's 5 revenue years. So let's say you don't do any revenue at all for the first couple of years, then it's 7 years. And TechCrunch, and this is all in the context of the creator economy, TechCrunch, was never raised venture capital. Why? It was a small idea in the big picture of things at that time. Its revenues were, something I don't want to disclose, but it was a long way away from that number. And when it got sold, the price reflected that. So then if you're Andreessen Horowitz reading this, you need to ask yourself the question whether there's a real economy here to be built that's big enough to justify the effort.
Yeah, and we wonder, I mean, the thing with TechCrunch is it's one of the few survivors. I mean, it seems to be prospering. How much is it worth now, do you think?
I actually think if TechCrunch would have waited even another year, it may have been worth hundreds of millions.
Did you tell Mike that? Of course you did. And of course he would never admit it. Anyway, enough of Mike. Let's move on, Keith.
No, let me just in case Mike's watching, let me just say this. I was consistently wrong about TechCrunch. Firstly, I told him not to do it. And then secondly, I was very pleased when he sold it. I didn't tell him not to. I probably should have, but he was ready to sell at that point.
Yeah. Well, he was a disruptor, and he continues to be a disruptor. He's a venture capitalist now. And the headlines, as always, Keith, especially given your new focus, is on venture disruptors. The big boys are disrupting everything. We talk always about Tiger Global, but what about SoftBank? I actually did in my How to Fix Democracy series this week. I interviewed Elliot Brown, who's just written a book about WeWorks, and he writes a lot about SoftBank and the guy who runs it, Son. And it's an astonishing story. It's astonishing how much money they've both lost. They lost with WeWorks, and yet they've come back. So talk a little bit about how you would distinguish SoftBank from Tiger Global, what the difference is, what the similarities are, and who's going to win between the two of them. Are they actually competing, or are they kind of both tigers enjoying themselves, killing everyone else?
So when we get to startup of the week, we can answer that question. But a bit of historical context here. The first player that played the game in the way that Tiger and SoftBank play the game was actually Yuri Milner from DST, which is a Russian. He's Russian.
Yeah.
He lives here in the Valley. And he went and invested in Facebook.
Yeah. But that was probably Russian. Was that Putin money he was playing with?
No, it was LP money. And by the way, he was the first venture fund to go and do a public offering, having data. So he's trailblazed two things. One is, and here's the game: overpaying compared to everybody else in order to win and get in. And so he overpaid to get into Facebook, did very well as a result, and then he did a public offering. That was the second thing he championed. Now, SoftBank is a public company, and it has a balance sheet, but it also raises funds. And it went out and raised 100 billion, called the Vision Fund, mainly from Saudi Arabia, and has been investing, buying Sprint, for example. So it's a hybrid. It doesn't only do venture, it also does public market buyouts, and it's really money management on steroids that because it's very big money, can produce very big returns in absolute numbers. But the way venture works, it's the multiple of your investment that is a signal of how good you are. And in the case of SoftBank, their multiple is, under 2, because they're investing 100 billion, and it's hard to get much more than 200 billion out of 100 billion, because you have to be successful.
How close did the WeWorks debacle come to really undermining SoftBank, or is it just a blip that there are always going to be WeWork style debacles in between the Airbnbs and other successes that they've had?
It undermined confidence in them, but it never was going to threaten them financially, because it wasn't a big enough component of their overall play.
It was bad press, though. I guess they don't really care. I thought of you in this book because who was the founder? Adam Newman, when he, he was a master of scale, or a master of ideological scale. So he would always talk about owning the whole world. And when he pitched Son at SoftBank, Son said to him, "You got to think bigger." So he's always thinking also, they're all thinking about, 100 billion or probably now $1 trillion companies, right?
Yeah. Well, so this article it's from Protocol. It's actually really good. It goes into the whole history. And it wants me to sign up, which I already did. So go away. This is Biz Carson. And the nice thing about this is it's both historical, but it also drills down into how Tiger plays the game, which is basically the DST playbook from Yuri Milner. They overpay, but unlike Yuri Milner, they do it, many, many times every month. So they are getting into every significant deal.
But they only overpay in areas and markets which make sense. They're not just going out to overpay for the sake of it.
Well, when you're putting money to work, there's two ways of looking at it. One is what today's price is.
Right.
And the second is what tomorrow's value will be.
Yeah, it's like buying a piece of real estate. You don't mind overpaying or bidding if you think that things are going to go up in the next year or two.
Yeah. So, here's the key. Tiger has shifted tactics with, SoftBank shifted tactics with its Vision Fund 2. It's now writing smaller checks similar to Tiger and has moved to investing earlier in companies, like leading a recent 100 million Series B round in which is a video conferencing tool.
Yeah, which you have something about later, where they're basically writing a blank check to a guy who's already proven himself, but they don't even have a business model. It's hard to tell even what they're doing. So there's an element of absurdity here. You have a link. I sent it to you actually, Keith, of an excellent Richard Waters Financial Times piece that is behind a paywall for people who don't subscribe to the FT, about how the entire venture business is doing really well in the current boom. So it's not just Tiger and Softbank.
Yeah, that's true. This is the paywall piece. I do actually subscribe.
Well, I gave you a link because I'm a subscriber.
Yeah, but those links expire after 3 people have looked at them.
Oh.
So I've looked at it more than 3 times, obviously. I'm a subscriber too, but I haven't got. We don't want to bore our listeners with logging into the FT. But yeah, I mean, venture as a whole has raised and deployed more money this year than any previous year already. Now they aren't all doing well. I mean, when you're an insider in venture, you know that there's basically a success curve. And at the top of the curve, there are funds like Sequoia that do many times the multiple of money that they put to work. And there's other ones that lose money.
Well, it's like Sequoia is the Cara of the VC industry. I mean, it's another winner-take-all industry, beginning at the top with Tiger and SoftBank.
Well, it's what it's turning into. I thought of a way to describe this. It's turning into something like index funds. Tiger is an index fund, in a way, on the best late stage startups. I'm building an index fund with Signal Rank for seed stage, and what we're moving to is index fund like participation in the venture ecosystem, which SoftBank hasn't learned that game yet. SoftBank is a cherry picker. It's not an index fund, it's a cherry picker.
I don't buy your idea, though, of your index fund or any of the others democratizing investing. I mean, as the Waters piece says, you've got to be an insider to make money. You've got to be an insider's insider. And I just don't believe it. I don't think a cab driver or a kid, unless they're very, very special, are going to have access to a fund like an index like yours. It's always going to be for insiders, for better or worse.
Well, if you are looking at the world as it is today, it's hard to disagree with you. But there are signs that that's changing. Tiger, by the way, yes, it's not democratizing because it's private money. And there's no way for you and me to play other than becoming an investor in their fund. And to do that, our minimum check probably has to be $10 million. So we can't do that. But there's a
you can, I can't.
There's a fund called Kinnevik in Norway, which is a $10 billion valued fund, and it's publicly traded. And normal Norwegians own its shares, and it's very successful. Draper Esprit, or Esprit, I think you probably should pronounce it, in London is similar. It's a publicly traded fund. And so there are ways to build index funds that are publicly traded. And as long as you do a good job in terms of what you buy into the index, normal people can benefit from the wealth that's created.
Well, normal people just as owners of stock, but they don't have the opportunity to scale their investments so dramatically. Things really don't change, and they don't change when it comes. We touched on real estate and investing. They don't change with San Francisco and Miami either. Lots of talk during COVID of the Bay Area being replaced by Miami or Austin or somewhere else. And now everyone, surprise, surprise, is coming back to the Bay Area. It's one thing I predicted hundreds of times, that suddenly everyone would rediscover why San Francisco is such a great place. I actually moved to San Francisco early this year, so from the East Bay. So I appreciate it as much as everyone. But San Francisco's still hot, Keith, right?
Well, it's coming back. There's been this long theme throughout COVID of San Francisco being finished and everybody leaving and rents collapsing and crime everywhere. And this is a New York Times piece going in the other direction, saying people are starting to come back. It focuses in on one particular individual and who tells his story having gone to Miami. And
Yeah.
basically says that nice as it was as an experience, it's not a keeper, whereas San Francisco is a keeper.
And we've got rid of the sort of the creepy element of the tech community, the Keith Rabois and the Peter Thiels. So I'm more than happy these people have left. I don't want to bump into either of them in the street.
Well, Keith Rabois, who I've had a few interactions with in my career, I don't think he's creepy at all. But he's a particular.
You're too generous, Keith.
He is a unique human being. That's true, and
that's your euphemism for creepy. San Francisco then is back. Are SPACs back again, Keith? They never really went away, but as always, you've got a SPAC headline in the newsletter.
Yeah, well, SPACs never went away. You're right, but they have flatlined in terms of value. They're flatlined, and but they're still happening because being able to take a company public when that company requires lots of capital expenditure, and the public markets are prepared to pay that and wait 4 or 5 years for the reward. That's what a SPAC does. And so this week, Aurora, and Aurora is a autonomous vehicle company that was the acquirer of Uber's self-driving unit back a few months ago, is announcing a SPAC at a 13 billion valuation. Now, why 13 billion? Well, that's not related to its revenue today. That's related to its revenue potential if it executes. And so people are prepaying for future revenue through a SPAC. And that is the SPAC game. It's again, it's a way of ordinary people. You can go to Robinhood and buy this SPAC now for $10 a share. It's a way for ordinary people to get shares in future big winners early. Now,
I guarantee you this one will end in tears. When ordinary people are investing in SPACs, they have no idea about. They have no idea of the companies. They have no idea of the future. They'd be better off going to Las Vegas and putting the money on black or red. Andrew, end of the middleman, Keith. We've heard that one before, but particularly when it comes to the financial industry, you're not a big fan of traditional retail banking. You think it's finished? We've talked about this many times before.
Well, it definitely isn't finished any more than, say, radio is finished. But
radio reinvented itself as podcasts.
Yeah. But what I'm really saying is there'll be a slow death. But I would say if you are an ordinary punter, you'll lose more money investing in banks than you would in SPACs. Banks don't represent the future. They represent the past, where you needed somebody to hold your money and then lend it out to 10 other people, earn interest, and when you asked for it back, you got it back. So banks make money by printing fake money through debt, things like mortgages and car loans. And
but finance is always fake. I mean, any kind of valuation, whether it's crypto or a physical coin or a note, they're all inventions. They have to be. They're all rooted in trust. They're not real. We don't exchange cows or pieces of beet.
Actually, it's a big discussion. We can't do it this week.
Yeah, well, maybe we. But your startup of the week is a really interesting company, which is truly disrupting the banking industry. You said that you are you use it. I need to actually look at it. It sounds very interesting.
Yeah, Revolut it's a UK based unicorn. Seedcamp seed funded it. Seedcamp is doing amazing.
Would this be the kind of startup that you would have tagged in your index?
Absolutely, it would have definitely been in there. And this week, Tiger Global and Softbank cooperated in investing in its latest round at a valuation of 33 billion. It's worth, if you don't have a modern bank account, trust me, download the Revolut app, sign up, it's free. Get their credit card, and if you're a traveler, their ability to move your money between currencies for free without charging you. It really, that you can buy crypto inside Revolut, you can buy stocks and shares. You can.
So they're taking on Wells Fargo, Bank of America, or Barclays?
Yep, all of them. They're taking on all of them. And it's a software bank with a banking license that sits on top of various infrastructure platforms. So it's bankers' software. And software is much better than human beings in providing you the services you want, and much cheaper.
And what about when it comes to regulation? Do they have all the licenses to?
Yeah. Oh, yeah. They're regulated.
And how do they play in the fintech world with, the Squares and the PayPals and the credit card companies? Are they in a different category?
Yeah, they're not strictly speaking a payments company. They're a bank. So,
but those companies are becoming banks, and banks are becoming payments companies. Everything's so fluid in that space.
Yeah, but if you go and sign up for a PayPal account, you can put your Revolut bank in as the source of the funds, for example.
And what's their business model? The same as banks?
They make money by I pay a premium account. So I think I pay something like $50 a year for a metal card that has various insurance when I travel and things like that. They also are getting into loans and debt, so that like all banks, you give a bank $1,000, it will lend 10 people $1,000. 1 to 10-ish ratio. It will earn interest, on your money that it lends 10 times, and you trust that you can get your money back whenever you want. It's not unlike Bernie Madoff's, Ponzi scheme.
Well, that's what the banking industry is. I'm surprised that one of the major banks didn't take them off the table. I guess they're not smart enough. And then when they did become smart enough, it became too expensive. It's interesting. It's a London-based startup. Your tweet of the week, Keith, from our old friend Steve Case, or one of your tweets of the week from Steve Case, suggests that, and we've heard this 100 times before, that Silicon Valley is finished. We know that San Francisco isn't. What did Steve say this week?
Steve wrote an op-ed in the Wall Street Journal titled "Innovation Moves to Middle America." And the tweet comes from the Wall Street Journal, focusing on that story of the post-pandemic future of entrepreneurship is not based or centered in Silicon Valley anymore.
We've heard that more than 100 times. We hear it 100 times a week. Is it for real? I mean, is there really innovation in Middle America?
There's definitely startups that are becoming valuable in many more cities than used to be the case. So he's right about that. But if you were to decide to have a career in investing, I wouldn't recommend Detroit as a place with enough opportunities to justify moving from San Francisco.
And it goes back to your piece about San Francisco coming back, and the comments of the guy who went to Miami. People want to bump into people, maybe not Peter Thiel or Keith Raboy, but they want to bump into other people on the street. They want to have restaurants and bars and places to meet other people. So this has been going on again for years, and Steve's been repeating himself. Maybe there's some truth, but I'm not convinced by that. Finally, Keith, a few months ago, we talked about Square's acquisition of Tidal, and we were both scratching our heads. Jack Dorsey has a tweet this week that is your second tweet of the week that perhaps makes a little bit more sense of Twitter's acquisition of Tidal.
Yeah, I added this after I'd finished the newsletter, just because it was it connected so many themes that we've been talking about over the weeks. So yeah, he announced at a conference in Miami, by the way, a Bitcoin conference. He was on stage.
All the Bitcoin conferences are in Miami.
And he was on stage wearing an orange sunshine kind of hippie tie-dye T-shirt with his long beard. And he announced that Square is developing a new business for developers that combines its seller platform with its cash app and the Tidal music catalog. And it's going to allow crypto to play a role there, which is what we predicted. We thought that the acquisition of
You
Tidal,
predicted. I didn't understand it, and I still don't actually.
and by the way, they also announced that they're going to produce what's called a hardware wallet for crypto. That's like a secure piece of USB connected hardware that means you carry your crypto around with you, and it can't be stolen from a cloud service like with some of the cloud services that store your crypto. So Square is definitely doubling down on crypto. There's no doubt about that.
Are you bullish on Square? It seems to me that this is still a very strange way of investing, not so much their money but their time. I still don't really understand it.
I am bullish on Square and Robinhood for that matter, because they're both coming in using software to manage money in different ways, and thus replacing lots of infrastructure that was built up over centuries that is really not needed anymore.
Like Revolut. Well, Keith, that was the week for July 16th, 2021. We may not be back for a couple of weeks, but when we are back, we will look forward to talking and to talking to you.
Should we tell them what's happening, Andrew? I'm going to Mexico.
So am I.
And so are you, but you have a special reason for going. It's up to you whether you want to.
Well, you can announce it, Keith. You can break the news.
Andrew is getting married and going on his honeymoon.
Getting married this time next week. So no show next week. My wife won't allow it, but we'll be back in 2 weeks when I'll be married and much better behaved.
And on that note,